With that, I'm going to pass the baton to our student, Lena, to introduce Waqas Samad. Thank you.
Hello, everyone. Good afternoon, good morning, good evening. I hope everyone is feeling really energized for another really great day. My name is Lena Jube, and I'm a second year in the MBA program here at Georgetown McDonough, predominantly focusing in strategy and operations. This summer, I actually had the opportunity to work with the Center for Financial Markets in writing a white paper about potential solutions for the challenges many private equity firms face in ESG reporting in the efforts to best demonstrate their strategy and the full impact of their investments. We were specifically looking at the food and health sector, which we know has seen tremendous growth and in need of more metrics. It was a truly incredible learning experience for me that had real tangible output. So many thanks to Rena and the Center for that opportunity. And now I have the distinct pleasure to introduce to you all our next speaker, Waqas Samad. After almost 25 years in the financial services industry, serving in roles such as the CEO of Barclays Risk Analytics and Index Solutions and Deutsche Bank's Head of Index Research Group of Europe and Asia, Waqas has most recently been appointed the Group Director of the Information Services Division of the London Stock Exchange Group in January of 2019. He joined London Stock Exchange Group in 2016 as the CEO of Benchmark Businesses, where he has been responsible for leading FTSE Russell's continued global growth into indices across all asset classes. With a career like that, we are definitely in for a treat, especially with Patrick Steele, CEO of Politico, and proud Hoya alum, moderating this fireside chat. So please join me in welcoming them both, Patrick Steele and Waqas Samad.
Thank you. Appreciate the introduction, Waqas. It's a pleasure to be with you this morning. Actually, this afternoon in London, where you are. We both spent about you've been about 25 years in the financial services industry. I spent close to 2 decades. We both came up through different capital markets routes. Mine was on the corporate finance side. Yours more on the research and analytics side. I'm curious, as you think about, you think about your 25 years in the financial services industry, what are, sort of a couple of the big changes that you've seen sort of over that period of time? And I guess just to open it up, sort of what are you most excited about in terms of, as you look forward to the future?
Well, first of all, great to see you, Patrick, and thanks very much for having me today. And it's great to be back at the FMQ. This has been, I think, a definite annual fixture in the calendar, because this is just a great conference. So well done to everybody for organizing this, and thanks, Rena, for the invite again. When I look back over 25 years, well, 25 years has gone fast, number one. I got into the space, my background was originally on the engineering and tech side. So I got into financial markets from a software development and tech perspective, and then kind of moved more into quant analytics and research, as you say, and then kind of fell into the index business back when it was still this kind of nascent thing. And I think that when I first started out, it was just at the beginning in the early 90s when the sell side, investment banks and other broker dealers and so on, were really starting to figure out how to take advantage of this tech revolution and the growth in availability and the cheaper cost of using technology in both internal processing as well as research and development of product. And that obviously led into trading systems and risk analysis and so on. So that was at the beginning of that. And just we've, in the last 25 years, been just an explosion in the adoption of technology in the space of financial markets. Sell side driving that particularly, the buy side catching up on that very quickly and adopting those kind of quantitative techniques for portfolio management and investment decision making, which necessitated further and further adoption of technology. And that's been in line with, in lockstep with the drive across the world, across many industries, to increase the use of technology that's available. I think that that obviously is all a bit of a, a truism and no surprise to anybody. But I think in the last 4 to 5 years, especially in the index and analytics space, there's been a real headlong rush into the adoption of technologies, and a real disposition in the financial markets community to just embrace new technologies much quicker than before. Everybody sees that now as a competitive advantage to onboard the latest thinking in, whether it's machine learning or whether it's in data science and large scale data processing capabilities. Everybody sees very keenly the critical edge that technology adoption can bring to their own activities. So I think that we'll certainly see that continue at pace. There's no abatement in the desire to try to beat the competition by having a better mousetrap, and that's going to be driven by technology very much in the future.
Can you talk a little bit about the last sort of 8, 9 months since COVID set in? Has that accelerated that push towards technology? Have you sort of noticed any change?
I think the key thing that I can kind of pick up on in our customer base in particular is naturally a changing appreciation of what risk factors there are in not only their own operations, but also in their investment thesis, in their investment, in the construction of their investment strategies. Obviously, historically people have looked at financial risks. They've been increasingly thinking about, which is the main thrust of the conference this year, they've been increasingly thinking about sustainability, ESG, and those dimensions are things that have been in vogue and gaining popularity over the last few years. But this year, naturally, everybody has been kind of blindsided a little bit by these risks that have been seen as outside of the system, not ones that they would necessarily have thought of from an investment thesis point of view. Perhaps in the insurance world, they may have thought about these things in the past from a risk perspective, but increasingly, I think people have been waking up to a whole set of apparent risks that they weren't considering before. Yeah. And so we're all kind of, I think, figuring out how to process that into our, not just our, how do we get set up at home and how do we, do video conferencing rather than meetings, but also how do we weave that into investment thesis? How do we weave that into the construction of portfolios? And I think that's added a new dimension to the ESG discussion, and will, for reasons I'm sure we'll get into, will even more redouble the focus on the adoption of new technologies and new capabilities to help them get to grips with that.
So you talked about sort of getting involved in sort of the capital markets industry at the dawn of the index business. How large, how big a piece of the overall sort of capital markets is now index investing? And maybe if you could just sort of describe, you run one of 3 strategic business units at the London Stock Exchange Group, the Information Services Division. Maybe talk just a little bit about your unit, and then also if you give us a little bit of sense for the size of the index business today.
Sure. So, the indexing world in the investment industry and financial markets has grown significantly over the last 15 to 20 years. That's in lockstep with a rise of what we all term passive investing, but who when I speak to customers who are labeled passive investors, they don't necessarily like that label. It sounds like they don't do very much. It's not that true, but that's the label that we use. So the rise of passive investing has driven an increase in demand for indexing solutions underlying those passive investment strategies and products. And that has also been another driver of that has obviously been the growth of the ETF industry, which is a vehicle for investors around the world, whether institutional or retail, that has really picked up in popularity. And you can measure the scale of the indexing space in different ways. One good gauge is to look at the ETF space because it's very apparent and very tractable, and that's grown to $5 trillion plus in total assets under management, and again is one of those areas that shows no abatement in terms of the growth profile. I think that as that spreads out in popularity across other asset classes, because historically it's been predominantly in the equity space, as it grows more in fixed income, which is growing at a real lick in the markets, we'll see that growth rate accelerate. In terms of our own activities, so as you say, the Information Services Division is one of 3 major divisions in London Stock Exchange Group. And in the Information Services Division, we have 3 major business lines: our index business, which is FTSE Russell, and we also have our analytics business, which is an area that we produce a lot of security level and portfolio level risk analysis for customers to use. It's got a lot of affinity with our index business because fund managers, asset owners, they are constructing portfolios to either track or outperform an index as a benchmark. And they also need to not just look at total return and performance, they also need to look at the risk characteristics of those indices. What kind of, if it's fixed income, what kind of credit risk, what kind of interest rate risk are they adopting when constructing a portfolio to track an index? So our analytics business is very closely allied to that index side. And then the third area is we have a whole bunch of data solution products. We produce the real-time data from our capital markets businesses in the group. We produce various classification schemes and underlying fundamental data sets that support investors who are trying to use other indices or analytic products. And in particular, out of there, we have our own proprietary approach to compiling ESG data from public disclosures of issuers, and then building our own ESG ratings, our own climate risk models, our own sustainability models, and so on.
Fascinating. So I only invest literally in my personal capital in the S&P 500. I have virtually no.
Well, we should talk offline, Patrick, because there's plenty of other things to invest in.
I know. But do you think I want to get to ESGs, but do you think that this growth of ETFs and index investing has led to the sort of the democratizing of the investment world? Has it made it easier for people to access what was once a very hard to understand sort of aspect of the world? I mean, what are your thoughts? Just has it brought more people into the global financial system?
I think that the approach of building products linked to indices has certainly enabled as you say, democratization. It's made it a lot more accessible. You mentioned the S&P 500. That's a very familiar reference entity for investors, whether they're retail or institutional investors. We have obviously other choices are available: the Russell 2000, the Russell 1000. Our own products in that space. But some of those names are familiar, and so people, I think, are able to more easily identify what their exposure is going to be in a product linked to those indices. Now,
by the way, I would argue, right, if you're just looking for sort of broad access to a slice of the capital markets, the Russell 2000 is probably about as good as you can get, right? I mean, at the end of the day.
So I think that's the point. It's that if the indices are constructed and explained and represented in a good way, it's a very tractable way for investors, institutional or retail, to be able to quickly identify what that exposure brings them, right? So I think that has certainly been a driver of the growth in use of index-related products. I think another one is obviously that the relative cost for investing, transaction costs and running fees and so on those index-linked products, in particular in the ETF space, has been driven down over time because the scale that some of those ETF providers has been able to deliver has meant that there's been a more cost-efficient way for people to access those exposures. I think there is a there's a flip side to it in the sense that the success of some of those things in helping that index space to grow in popularity has meant there's been a proliferation of indices, has meant that there's been therefore a need for index providers and product providers to work harder at explaining what all you are investing in when you invest in this index linked product or that index linked product. So we have to be a bit careful there, if in all honesty. But there's a lot of work going into doing that and making things more transparent and explaining, and disclosing what the dynamics are of particular indices. But education is there's a big demand for more education about what an index is doing. The obvious ones that you've just quoted, the Russell and the S&P, some of the other indices, those are the headline flagship ones that people know pretty much what they are. But there's a whole plethora of, country exposure, emerging markets exposure, fixed income indices that give you credit exposure, mortgage backed, and so on. More education and information is required there. And that's one of the roles of the index provider in working with product partners who are providing the funds and the investment vehicles. We have to work hard to help people understand exactly what they're investing in.
So you mentioned use the term passive investor. How does the FTSE Russell fit into that ecosystem of active versus passive investors?
Well, so I mentioned that obviously the growth in indexing has been linked very much to the rise of passive investing, but actually the whole story is that active investors, of course, are measured on their performance by their stakeholders, the ultimate pension funds or asset owners, with reference to a benchmark. And so active investors are using indices very extensively as well. So FTSE Russell, I think, I wouldn't say it's 50-50, but it's, it's not far away from that kind of split in terms of our consumer base for our index products and the data sets that we produce to support those. That's split, roughly speaking, 50-50 or thereabouts between active and passive customers. I think that there will always be the demand from the active investment community for those kind of reference benchmarks. But increasingly, when you think about the new wave of investing that's coming along with this whole sustainable finance theme, data sets that are used, that are compiled by us and used in producing the indices are also very attractive to those active investors. That's the fuel that all investors, active or passive, need to feed into the process for building their own strategies.
Is the ESG investing space, is that one of the faster growing sort of elements to the index business? And
oh, for sure.
Yeah, and
for sure.
I'd love to know where you're sort of seeing the most innovation happening right now.
Sure. I mean, ESG, there are a range of themes that are driving us. We're very lucky to operate in an environment which is rich in demand, right? The challenges for us are not so much in generating demand, they're more in making sure that we can, satiate all that demand, but from the supply side with good products and with good process. But out of the range of themes that are prevalent today, things like, more demand for fixed income index products, more demand for factor investment products, and so on. ESG, sustainable finance, is by far and away the biggest theme. We hear about that in 99% of our customer conversations. Even if they don't start that way, they end up talking about
99%.
ESG.
It literally comes up on every call.
Almost every call or discussion, it's what have you got for us in data sets, indices, risk analytics, anything to do with what we produce, what's the ESG or climate risk or sustainable investment twist to that. And one stat that's interesting is I was looking at some data from Morningstar. In 2019, inflows from US investors into sustainable finance, sustainability funds was about $21 billion. And that was 4x over 2018. So that just gives you an indication of the pace of change and demand in that space.
And again, I'm CEO of Politica, right? We just cover politics and policy. We had a very consequential election. You've got President-elect Biden and Vice President-elect Harris administration coming into power. How do you see the ESG environment sort of changing in the US as a result of that election?
Well, I think the received wisdom on the policy front has always been that the EU, that Europeans are ahead. There's growth and rapid uptake of ESG and sustainable finance principles in Asia, but the US from a policy environment has maybe been a bit of a laggard. And that's obviously linked to whatever the prevailing policy environment is and views are held by the administration. That said, in the investment community itself, the focus on building sustainability funds and ESG related products has still been there regardless of what the policy environment is, because the demand is coming from the end investors. So we do an annual survey with asset owners around their disposition to sustainable finance and ESG related activities, and we saw the biggest upswing in interest in building sustainable funds and sustainable portfolios from the biggest growth in the US, almost double the response rate that we had the prior year in 2020 versus 2019. So the investors are all doing that, even in the face of a policy environment that might be a little bit orthogonal to that, if you like, if that's one way to say it. With the new, what we anticipate is with the new administration coming in and making all the noises about creating a more favorable policy environment to support those kind of investment theses, I expect that to grow even faster. We're seeing something similar in the UK. Obviously, the UK is hosting next year the delayed version of what they call COP26, which is viewed as being one of the most important sustainability-focused conferences or policy environments since the Paris Agreement. And the UK government is really positioning very strongly for transforming the economy into a green economy. We've seen things come out today, even from Boris Johnson's administration around that. So there's a real, I think, shift in the policy environments that we are operating in with our customers that seems to be adding more tailwinds to the momentum here. And I think we're going to see an even bigger push from our customers in the financial markets on us to produce tools and data and analytics that can help them to deal with that.
So for all of you Georgetown business students, big opportunity, huge growth ahead. This feels like a great area for students to be sort of thinking about right now, because it seems like it's going to be a big opportunity for growth over the course of the next 5 to 10 years. I mentioned, we caught up a week ago, just briefly. I mentioned I had worked at the US Department of Agriculture, and 20 years ago when we put together the first organic rule that basically established the rules around labeling food organic. And organic has grown by 15% a year, literally compounded over 20 years as a result. As you think about ESG investing in data, how do we create more consistent, better standards for what it means to be an ESG investor?
So it's a long, hard road, because we're starting from an environment where there isn't an accepted framework of materiality of some of these measures and key performance indicators on the end result in terms of performance of a company, right? Whether that's on the income side or indeed the performance of the stock price. It's not so clear cut compared to a regular financial market, regular accounting based or financial analysis of a company's performance. How do you relate the carbon footprint of a company's operations to either income generation or performance of the stock in the market? Those frameworks for linking those measures, which are important and increasingly becoming required by regulatory bodies for disclosure? How do you link those to performance? That comes from two different directions. One is you need standards for the disclosures in the first place, so that there's consistency in what companies are saying they are measuring and doing and measuring about what they do. And then you need some consistency around the interpretation of those measures and to be able to relate those to the impact on performance of the company. And those are often, of course, going to be calibrated to the particular sector, industry sector they may be operating in, but still there need to be some kind of standards on a sector-by-sector basis. There's work going on to do that. I think the complaint from both the issuer side and the investor side over the last few years, as this space has been growing, is that great, there's a lot of data coming out. It's inconsistent, it's patchy, even though there's a huge amount of demand from investors to get this information disclosed by issuers. It's quite hard for issuers because they've got one set of standards that all the models that are being built around this stuff are proprietary at the moment. So we might have a proprietary model that requires information from a company on certain parameters. One of our competitors might have a slightly different model and want different information. So you've got poor old investor relations teams at corporations who are, struggling to get hold of all of these different requirements from people to disclose data. A standard-based approach will help. There's great work going on from a number of bodies to try to pull these standards together from a lot of disparate data sets at the moment. So the IFRS is looking at this. There's a body called SASB, for example, which is looking at this. There are a number of NGOs which are also contributing to that. And we as an index provider at FTSE Russell are continually contributing to consultations and initiatives to try to help guide to a set of standards that's tractable for investors to use. And in the London Stock Exchange Group, because we have our capital markets business where companies are listing, we're also working with issuers and corporations who are trying to access the capital markets to help them navigate this currently quite messy landscape, to help them to disclose in a way that enables them to connect with providers of capital more easily. So it's an evolutionary process. It'll get better. There's great work going on at the moment. Lots of people from all sides are contributing to that. And an important backdrop is, as you said before, the regulatory environment can really help. I love your analogy about figuring out what organic really means and standardizing that. That's going to really help if we can do this, the analog of that in the ESG world. And then the push from end investors, big institutional asset owners, pension funds, and so on, is definitely there now globally. And they are demanding from their asset managers, from companies that they're investing in, whether that's public or private markets, they're demanding much more disclosure and information. So with all of those forces pushing, we're hopeful that we'll get to some set of standards pretty soon.
And I mean, ultimately, you said 99% of your client discussions are, asking about ESG. Ultimately, it feels like the cost of capital for businesses that are, are acting in sustainable ways with consideration for the environment and climate, that cost of capital should be going down pretty quickly, which should only sort of foster more growth in those areas, right? So it's a pretty virtuous circle.
I think the long-term, medium to long-term view is that virtuous circle should help to push down the cost of capital, because, if you've got a system that is enabling you to tap into the capital in order to manage risks, right, then you should be able to see a virtuous circle, as you say. I think, though, at the stage that we're at, people are still trying to figure out what those risks are, what they mean, what the impact is on their operations or on their income from when those risks become apparent and when they have exposure to those. So we're still at a phase where it's pretty nascent, and people are trying to sort all of this out. Sometimes people say it's analogous, ESG ratings and these kind of risks that it's a similar evolutionary phase to credit risk models in traditional financial analysis. I don't quite agree with that. I think it's a little simplistic in the way that analogy is drawn. I think the big difference is that in a traditional accounting-based analysis of credit risk, financial accounting-based analysis of credit risk, there is a pretty clear line between default and the way that the company's leverage, for example, is gauged. Whereas with ESG risks, the financial materiality is not standardized. There's not a standardized model for some of those ESG risk parameters relating directly to financial metrics or financial measures of credit risk or other financial risks. So as we figure those materiality points out, I think we'll get to a much more tractable set of risk measures for investors to use as they build their portfolios. But we're at a stage where we're still trying to sort out what those are.
Yeah, we have a couple questions I want to get to, one from Rena and then one from our audience. But quickly, we run Politico has a large business based in Brussels that covers the European Union. We launched our sustainability policy vertical 3 years ago. We're just launching that sustainability vertical in the US now. The US always seems behind when it comes to climate, environment. Do you see the US catching up? I mean, do you have a sense that there's real momentum around these issues in the United States relative to Europe? And will you ever see parity between how Europe approaches ESG and how the US thinks about it?
I think that is the US a little bit behind in the policy arena? Sure. As I said earlier, I think in the disposition of investors and product providers, I think the fastest growth that we're seeing is there in the US and in Canada. So I think there'll be catch up. I think that again, as the new administration comes in and sets a potentially different policy environment, that will spur it. The EU is ahead. The biggest thing I think that reads on investors in the US is obviously a large number of them are global and providing solutions for customers globally. So in the EU, you now have the EU taxonomy for green finance, which will come into legal force in January 2022. That compels 6,000 or so large EU corporations to disclose disclose certain measures of their operations against the metrics in that taxonomy. And it means that product providers, financial product providers, sustainability funds and so on, sustainable finance funds and so on, have to also explain how they are sustainable versus the EU taxonomy. So that it's an attempt to combat so-called greenwashing and so on.
Yeah.
That is something that I think US firms are trying to get to grips with because they operate in the EU. And I think that's an approach. Taxonomy is another driver for standardization. And we have produced a really tractable set of tools for customers to be able to get to grips with that. We've launched quite recently this green revenues classification system, which is aligned with the taxonomy. So customers can easily use that to figure out what the 16,000 companies that we have evaluated against that classification system, what their income is along a whole bunch of different 10 macro sectors and 130 micro sectors. What income are they getting from clean energy or from water processing, sustainable water processing type of activities? That will help investors and issuers to deal with the EU regulatory requirements.
Interesting. Professor Rena Agarwal asks, any thoughts, you're talking about different sectors of the economy, any thoughts on real estate and ESG investing, indices that sort of allow you to invest in that specific asset class in the ESG arena?
So Rena's very on the mark to point out that there is, of course, demand in that space as well from investors, because what started out as just tell me what certain cash equity issuers are doing in ESG has spilled over into all asset classes. We have done quite a bit of work with both EPRA and NAREIT, who are listed real estate data providers, to build green or ESG versions of our FTSE EPRA NAREIT real estate indices. So that's in the listed space. But of course, there's a huge demand from big asset owners who have private asset exposures in real estate to try to understand what those investments are doing, again, in the context of ESG. Now, I think the private markets is an area that is much further behind the curve compared to the public markets, naturally. And it's an area where, if we think the data is a little messy and a little unstandardized and unstructured in the public markets, right, for corporations that are listed, it's even more complex and challenging in the private market space. So here is where we're doing quite a bit of work from a frontier and research type of work to figure out what's the right approach. A lot of the data in this space is very unstructured. So this is where you have a nexus with technology and natural language processing, machine learning. You need to take a whole bunch of unstructured disclosures and documents and process them to figure out how to then map that to some sort of taxonomy or classification system and then do the measurements from there. Yeah. So I think that stuff's coming because there's demand from the private market investors as well.
So we've got a question from Pedro Voigt. He asks, you already talked about sort of demand for ESG investing growing substantially. Which financial products are more likely to be used, developed to meet this growing demand, specifically around ESG investing?
I think it's across the board, honestly. We see ETF providers asking us to build solutions for them in conjunction with them to take to their end investors. We see people on the exchanges, that we work as partners with. We've been doing a lot of work with, for example, recently the Singapore Exchange and launching new futures linked to our indices. There's demand coming through there for ESG related products because their consumers, their market participants are looking for those kind of hedging tools and futures to help them in terms of managing their risk exposure to various different sectors and geographies. We see big asset owners and pension funds trying to reshape their existing portfolios to line up with some of the ESG principles. Sometimes they're doing that in line with the United Nations Sustainable Development Goals measures. Other times they're using our own proprietary models for that. We just did a very large project with a third-party partner called the Transition Pathway Initiative, who measure the readiness of companies to be able to adopt changes in their operations to meet the Paris Accord climate targets. So they have a metric system that we use to build indices, and then a big asset owner, the Church of England Pension Board, actually then put in a lot of assets to track that index so they could reshape their portfolio against that. So it's coming from all different segments of the ecosystem, whether that's the sell side, the buy side, asset owners, asset managers, derivatives providers, and so on. It's now, and I think that's accelerated, by the way, in the last couple of years. I think until a couple of years ago, very much driven by asset owners who wanted to reshape their investments in line with their pensioners or stakeholders' desire and wishes to be more sustainable investing, more into sustainable investing. But because they don't operate in a vacuum, they operate in an ecosystem, all the other parts of the ecosystem are now coming to that. So banks, regulators, exchanges, liquidity providers, everybody has to then line up and look to provide solutions along those same dimensions. So it's coming from all sides.
So unfortunately, we're running out of time. I want to ask you one last question before the next panel comes on. And I'm going to give it a little bit of a preface. We're seeing extraordinary engagement with our content around the content that we produce in the US, Canada, and Europe, specifically Brussels, around sustainability and frankly, ESG policy. Just extraordinary. People will read everything that we write on those topics. And so it tracks what you're hearing. You said 99% of your clients are asking about this. Where do you see the future of sort of global index providers? Where do you see that future going?
So I think up to now, there's obviously been for the reasons we discussed, people moving into more indexing, whether that's active to passive or whether that's because of lower cost and so on. We've talked about some of those drivers. Increasingly, though, I think that that trend will continue, I'm sure, for the next 3 to 5 years. There's still untapped demand. There's still portfolios to shift into that kind of approach of constructing their exposures. I think, though, that at the same time, what's growing is a much more quantitative, data-driven approach to investing. That's sitting, that's there because there are drivers like ESG, where you just need a lot more data. It's also there because you've got things like algorithmic trading strategies and quant investment funds that are building up, building in popularity, and that also is another driver for the use of and the demand for data and analytics that support that. I think that indices are one expression of that overall demand for data and analytics and tech to drive investments. If you think about it that way, the demand for index products will continue to grow for the foreseeable future. But what the bigger context is just data and analytics driving investments and markets much more than before. That's our thesis. That's our belief. That's actually a driver for why London Stock Exchange Group is actually embarking on a transaction to buy Refinitiv, which is one of the world's largest data and analytics providers. And that's something that we're going through the process of getting regulatory approval for. But that's our strategy. That's why we are going down that road.
Phenomenal. I mean, honestly, such an interesting discussion. I wish we could continue to talk, but I'm going to pass it back to Rina. But Waqas, really just excellent to hear what you're doing, and such a big opportunity, growth opportunity, as young business students thinking about sort of areas of growth. It just feels like you're right in the middle of a very exciting part of the economy. So thank you for your time.
Patrick, thanks very much. Really enjoyed it.